everyone. We're Steph and Rachel, the creators of Wealth, Wisdom, and Wellbeing podcast. The spirit of this podcast is to share the conversations and curiosities that we have with a greater community in the hope that we can develop wealth, wisdom, and well-being for ourselves and those around us. Simply put, we're in the pursuit of financial freedom and opportunity, meaningful relationships and experiences, and an increased quality of life to be able to enjoy all of it. We just want to live our best lives and help you to do the same. Come with us on this journey. Let's have some laughs, learn from our communities, and get that bread.
Yawned out, Rach. So gloomy today, so we gotta pump up the energy. Oh. Okay, so the intro will go. I'm actually not going to play it. I'll just add it in. Hey, Rach. How you doing today? I'm good. Happy Sunday. It's getting closer to spring over here. We're slowly being teased in this Alberta. Well, it's not untypical for Alberta, but I'm just ready for some sunshine.
First of my fires in the and then we got that dump of snow and they were
so
yeah. Gee, Homer had quite a response to them like being bent. The flowers are dead.
Oh no.
Yeah. So to your point, we got teased with spring and then winter rears its ugly head and just dumps all over us again. And here next weekend will be nice. So let the camping begin.
High 20s, the camping, exactly. I saw like the dandelions are out.
Yeah.
And it's so funny. We like hate on dandelions so much, but now I don't know what it is, if it's mid 30s, but I'm like, oh, I could make like dandelion tea and all this random stuff. Oh my gosh. But I have not done it. Yeah, you can actually eat them. They're edible, hey?
Mm-hmm.
And there's supposed to be a lot of good benefits to that. But yeah, anyways, totally random. How was your week though? What'd you get up to?
It was good. We went to Vancouver to see Justin Timberlake. He had his opening show for his newest tour. And it was really, really good. Yeah. So we spent a couple nights, saw JT, fangirled hard, and then came back to normal life, back to work.
That's so fun. I never was an NSYNC girl. I was totally a Backstreet Boys girl. However, when JT went on his own, all in. Like, yeah.
Big fan.
You can't stop that feeling. It's just like,
no.
Okay. What was his best song? Which song did you love the most?
He closed with Mirrors, and that was so good. It was so good. Yeah, he was on this floating rectangle that had all these LED lights on it, and he like went over the crowd. It was just
cool. He was like up in the air, like wow, magic carpet style.
It was pretty amazing. Very cool. Jessica Biel was there.
Yeah,
she's such a rock. Yeah,
she is.
Yeah, it was really, really cool. How about you? How did your week play out?
It was all right. It was a little bit overwhelming this week, honestly. It just seemed like it was jam-packed, but it was great. We also actually went to a concert. We saw Cody Johnson here at the Saddle Dome and had a blast. It was just Sean and I, my partner and husband, for our listeners, we have not prioritized date night. So the fact that we've been doing that for the last couple months, wow, it makes a huge difference.
Mm-hmm.
I mean, I know that sounds silly to say, like, yeah, of course it makes a huge difference, but you don't realize when you're so caught up in life how important it is.
It's really easy to get caught up in your routine and I'll just put it off. We can do it next month.
Absolutely. And I literally think for the first like 3-4 years of, our daughter's 4 now, we haven't prioritized that. So
Mm-hmm.
it was great. The concert was awesome. Totally different than JT's, I'm sure.
Yeah.
It was very country, but it was, we love that. So yeah.
Good for you.
Thanks.
So,
Well,
Steph,
Rach. Yep.
we are going to jump in. We're going to jump into investing.
Yahoo.
Yahoo!
We've been waiting for this episode. This has been the one. I know we've done a lot of, last episode was talking about the different accounts, right? And these financial type tools for banks and all of these type of accounts we can use. So yes, I'm excited about this investing.
Yeah, I feel like we've led up to this point, right? Talking about our money mindset, the accounts like you mentioned, getting your expenses and income in line so you know what you actually have available to invest. And now it's time to put our money where our mouth is. So
let's do it. Yes.
Let's do it. So now that we have the budget, and I'm hoping our listeners, if you've been listening to our past episodes, have gone through the exercise to look at your income expense, your savings, see what you have left over to pay yourself. Now we can invest. So this is where stuff I assume people get overwhelmed because now there's choices to be made about where to grow their money. And there's a lot out there, so it can be a bit scary. But this is what Steph and I love to talk about. This is where things start to get juicy. This is where we get wet. So let's do it.
Oh, it's too good, Rach. Yes, let's do it. Okay, and I think our listeners are going to kind of be hopping on that train, once they get these foundations too. So I just wanted to start out. I love following on Instagram. Let's do a shout out to the Market Hustle. There's no sponsorships yet, but I love their content. And there was this kind of meme thing. So I just wanted to share that. We'll put it up here on the video too. So it says, the life of an investor be like: checking account, $294 for spending. Savings accounts, $9,000 for savings. Investment account, $478,722, future freedom. And then this investor says, sorry, I don't have any extra money to spend. I just love this because it just shows the mindset of us as investors and what you get. You're like, yeah, of course, in your head, you're like, I have money, but that isn't touchable. So that's not something I'm willing to spend right now. All about the long-term gain.
For sure. And it feels good to be able to do that. I'm in that mindset right now, especially we just did our trip to Vancouver, which, I mean, you go anywhere, it's costly. So now I'm back to, okay, I'm not going to buy coffees this week. I'm not eating out this weekend, which is fine. It's just what is comfortable for me.
Yeah.
But I feel like it supports this piece. Like, I just don't have that money right now. I mean, sure, it's in the bank, but it's working for me, so I don't want to touch it. So it's a good thing to kind of revisit.
Yeah, and it comes back to those priorities for sure, and delaying that gratification, I think, hey? So it really ties into our conversation from last time too. So I guess to just dive in and kind of get started a little bit, we're going to just set the stage with what is even the stock market. So basically the stock market is it's this collection of markets around the world that you're able to buy a portion of a company. So the company that would be public, those are the ones that are on these stock exchanges or markets. That's kind of interchangeable terms. On the market or on the exchange, there is a whole bunch of different financial securities that exist. So that's what we're going to talk a bit about today. Things like a stock, an EFT or an exchange traded fund, corporate bonds, commodities and currencies, bonds, so many different things. Don't worry, we're going to break it down super easy. We got some analogies here that even your 5-year-olds could understand. So Now, there's quite a few different exchanges. So we've got one here in Canada, the TSX, the Toronto Stock Exchange. Then there's a few in the US. There's actually a new one I even learned about, I didn't know existed, which is the Chicago Board Options Exchange. The more common ones are the New York Stock Exchange, which most people would see in movies and have heard about, and the NASDAQ.
Mm-hmm.
And then, of course, there's also international markets. And, you're able to purchase companies that are international through maybe some of these more local exchanges, right? Too. So yeah. So Rach, I guess, do we want to dive into a little bit about how we go about buying the stocks and just how that works?
Absolutely. So you can't go to Wall Street, the most famous of the streets, and show up with your money and say, I'd like to buy Google. You have to use a broker. So, and brokers, there's all sorts of brokers, robo brokers, full service brokers, but basically it's very simple. You can buy stock through, or securities through, your banks. You can buy them through, we've mentioned Questrade before, but there has to be some catalyst that you use to be able to buy these financial, what am I trying to say?
Yeah, the financial securities.
The financial securities.
Yeah.
Stuff. So once you establish who you want to use or the platform you wish to use, then it's about just getting the information and making some decisions about what it is that you want to buy. So, Steph, when we think about, I guess for me, and two, let's just also add for our listeners, once you listen to this episode, if you still have questions, do a deep dive of the internet. It took me a few times. I'm still Googling and kind of refreshing my knowledge and trying to update myself. It wasn't a one and done. I didn't, read Investopedia, what is stock, and then say, oh, I totally get this. I still don't really understand Bitcoin, and I can't even tell you how many times or how many articles I've read about it. So don't be overwhelmed or worried if this doesn't hit right away. It's very
or
normal.
Just realize that those are normal feelings. Like if you're feeling those, totally normal.
Yeah. Okay. So Steph, can I ask you maybe to start us off and tell me about your approach?
Yeah, sure. We can dive into that for sure, because it's something right now that my approach, it's going to change as I get older. So I'll just preface this with the approach from the research that I have done. I have a long time horizon. So I have chosen to invest in a way that is higher risk because I know that I have time for the market to do its cycle. So the market, there's things called bull markets where things are going really high, really fast. And that's what everyone wants. We want the bull market because that's when you're making the money off of your money, right? And then we've got bear markets that happen in the stock market. So that's when it crashes, and that's where the big fear is that, oh, I'm going to lose all my money with the crash. But as we've mentioned, you don't lose your money unless you pull that out. So as long as you're in the stock market when there's a bear market and it drops and you ride the wave for it to come back up, that is your best friend. You're going to be okay.
I have a trick to remember: bull is high, bear is low.
Let's hear it.
Bear is I'm barely making money.
I like it.
I'm just going to share that. Go ahead.
Yeah,
Sorry.
I love that. That's great. And then with these markets, what we know is that there's some sort of cycles. I mean, historically, I have to say like 7 years, every 7 to 10 years, I think there's a bear market. And then every couple years, there's like little mini bulls. I don't have the exact time frames here, but it's kind of cyclical in some senses. COVID, things like this that happen in the world, it messes with these things. The other piece, I haven't gotten to my strategy yet and where I'm at and invested because I just got totally squirrel. But when you're looking at this, so what we can do, and actually this would probably be a good thing to just pop up and I'll show a picture here. So you can zoom out, and this is what you want to do. Because when you're looking at what the stock market is currently doing, if you have, and you see there's like, it's up 20%, but you're only looking at the last, let's say 6 months, that would be actually amazing, right? We'd love that. So you'd be in a bull market there. But regardless, you want to zoom out. You want to see the entire time frame so you can see this pattern of what happened. So down, up, but it's always trending up. Yeah. So just wanted to point that out. So with that being said, I'm in late 30s, mid to late. I think I'm in late 30s now, I can say. 37, yeah, late 30s. Woo! But I have about 20-ish years. Actually, less for me is what I'd love to plan. But let's say I have 20 years, right? Where I would like to retire. So what I've done is I've done more of a passive approach. I use Questrade as the broker I go through. They're online. No longer do you have to write out little chits. Never was that a part of my thing. But everything is through an app. It's online. It's easy. And from there, I wanted to do that because it's passive. It keeps the fees really low because I am actually doing the picking of where I'm putting my money and then the purchasing of it. So I can only do this on certain times of the week and the day when the stock market is open. And to keep it really simple at this point in my life, what I've chosen is to do something called an all-in-one ETF. So an ETF, basically, I mean, we didn't talk about stocks quite yet, but ETFs are a collection of stocks. It's kind of like you've got this pie and you're buying a piece of the pie. And you've got a little bit of a basket of it, right? So there's a bunch of different things in there. So you might have, let's say, for example, you're going, and I love this quick little breakdown. It's like you want to buy an apple, an orange, a banana. It costs $10 and you only have $5. So instead you buy this little piece of an apple, a little piece of an orange, and a little piece of a banana. So you won't be able to have the whole piece of fruit, the apple, the orange, the banana, but you can have at least a little bit of each. And this is basically what ETFs are. What I love about one and Motley Fool, and there's Kids Academy, really great resources. We'll put them in the notes here too. I wish I could take credit for that. I can't, so I'll give them the credit. Money Prodigy, wonderful tools for teaching kids about stocks. And let's get real, ourselves. Because if we can break it down that simply, it makes it a lot easier to understand. But anyways, just to go back to my strategy here, the all-in-one approach, why I chose to do that, you pay a little bit more of a fee in your self-directed account. Basically, though, you don't have to go in. It's like you set it, you forget it. You don't have to go in and do the rebalancing. And because I'm doing it myself, I would have to if I chose a different approach, just to make sure you don't get too heavy on a higher risk area than you want. You want to keep your ratios kind of the same.
It's the Instapot of investing. You set it, you forget it. And you don't have to worry about your house burning down.
100%.
It's going to be okay. Yeah.
I like that.
Shout out to Instapot.
Rach, you could be you're going to be coming up with these analogies. Yes, the Instapot of investing. So yes, and I've done more of a moderate risk type profile. So most of my portfolio, about 60-70%, is an 80-20 split, meaning 80% is high equity, 20% is bonds, which is more of a safe, secure investment, but you get less of a return on those. And then the other part of my portfolio, the remaining, is 100% equity. So I do have a few individual stocks, and then I do have a few ETFs that are 100% equity. So it's the highest risk you could go.
You just commented on something that I just want to expand on. You mentioned bonds, lower rate of return. Bonds, what that represents is the lower the risk, the lower the rate of return. The more risk you take as far as securities, the greater potential for return, because nothing is certain. Bonds are certain, which is why the risk is so low and you get whatever it might be, 2% over 5 years. The higher the risk, the more potential for return. So thanks, Steph. Thanks for sharing your MO. You did mention you have some stock, mostly ETFs. I tried for probably a year to do some investigation and buy standalone stocks. So not part of an ETF, not part of a mutual fund, where I'm using, again, I use Questrade. And I would on the side research whatever stock it was, find the ticker in Questrade, and buy whatever I had worth at the time. So, and I'm going to say these stocks, but it's not, I invest or not, you do your own research. There's no tie to me for these companies. So
yes,
I had bought a data mining ticker, HUT, which of course, being a newbie, and this is where stock purchases can be very risky, because you're kind of putting all your eggs in one basket in a sense, right? So I bought this data mining company stock high. Great time to buy. It's not. That's not true. Please identify the sarcasm in that comment. Don't buy high. And I lost money, and it wasn't a ton of money, but it's my money that I earned, and I lost it, and I'm not going to sell it now because I'm like, well, I'm already this much in the hole. But that did not go well for me. And then I bought Sleep Country because I was reading an article that said people always need beds. It doesn't matter if it's recession or a COVID, people need beds. So I was like, great, this is going to be fantastic, foolproof. Bought Sleep Country. It was fine. I ended up selling it because I needed the cash, but I didn't make a whole lot. And if I had invested that amount into a fund and had left it there for the same amount of time that I held on to this stock, I would have made more money. And same thing with some car tickers that I purchased. So when I purchased the stock, I became part owner of Sleep Country, of the data mining company. So when you buy stock, you get voting rights, you get a piece of the dividends if the company has dividends. You become part owner of that company. You've invested your cash, and they're giving you a tiny, tiny, tiny percentage of ownership. So, which is why I've never voted for anything when it comes to these companies. I get the sheet in the mail. I read whatever there is. I read about their earnings.
Yeah.
And I'm not saying you should do this, but this is how I've identified in myself that I shouldn't own specific stocks, because I don't put in the time. I don't follow up with what's happening. It's not passive enough for me. So I hope that gives our listeners an idea of what it means to own a stock, and how I'm not a good example of the type of personality that should own specific stock. I need someone to do it for me.
Though, Rach, I think that is part of the learning, because in this journey, we all are going to make mistakes in it. And by doing your research up front, it's going to try to mitigate the number of mistakes. And by listening to other people's experiences, reading books, but sometimes you just have to go through it and to get that learning. There's a few things that came up there that I was kind of thinking about just based on what you were saying. So with the stocks that you chose, can you tell us, the listeners and myself, how you came to pick like Sleep Country specifically rather than Beauty Rest, or I mean the Brick, or somewhere else that sells mattresses, and also that mining company? Like, how did you come to pick those individual companies?
So the mining company was like over 2 bottles of wine at a Christmas party. So
Was
I
it the
did
word
not.
of mouth thing?
Yes.
Was it kind of
Yes.
like someone, okay, yeah,
Yeah. So that was that one. And that was my
yeah,
worst performing stock.
right,
The Sleep
right.
Country one, I read something on, I think it was through Motley Fool. And when I looked, when you talked about high level, looking at the ebbs and flows of the stock value and just seeing, sure, there's ups and downs, but if you look at like a 5-year span or horizon or a 10-year horizon, I shouldn't say horizon because that's looking ahead, but I mean historically, looking back,
Mm-hmm.
you should see somewhat of an upward trend. So for Sleep Country, when I was looking, they were low. So I did buy them low, which kind of is what made me pull the trigger on Sleep Country.
Right.
And then I had another one, which was Auto Canada, that I purchased, and they were also low. The stock had increased in value during COVID when people were sitting on money and wanted to buy cars. And then it dropped when things started to open up and people had to start paying back their COVID bucks. And that's when I bought. So I think they dropped in price by like 30%. So that was, but it's a lot of, you can Google top 10 stocks to buy this week. Or you might, Yahoo Finance has, not a newsletter, but information they put out weekly about what to know in markets. And that's basically was my guide. And then I just looked in a little bit about, mostly just looking at the historical performance and seeing where they were. Because fool me once, mining company, I bought you high, I wasn't going to do it again. So that's how I did it.
And I think, like, thanks for sharing, Rach, and being so vulnerable with that, because it's hard when, like, especially to our egos, you know, but we got to put the egos aside and just, like, take the lessons from it. And I think one of the big things, though, I'm hearing is, okay, the hype on things, usually that's a big red flag. Like, if people are really hyping a stock or something, we cannot predict the stock market. We do not know what's going to happen.
Yeah.
There are trends that happen, but for individual stocks, it's so important that we do our research. And we are not experts in this by any means. And there's a lot of other really great podcasts and people like the Canadian Investor. They speak really well to this, how to pick like different stocks. So for example, looking at the financials of the companies and doing a lot of research. So we want to be, if you are going to be choosing stocks that are individual, doing our due diligence with research. What is the market cap? What is the historical performance of this company? How much debt do they have? Who is running the company? Do you have confidence in that, C-suite team? Because these things are really important when, if, you have people running this public company and they are hot-headed, they make quick, impulsive decisions. This affects you as an investor as well because you own part of that company. So you just really want to believe in the management as well. And with that, this is where stocks are a lot more work because you have so much more to consider. And this is why I think investing, hey, Rach, gets such a hard rap because people think that you can only go, and this is the horror stories they hear about, is people picking stocks and losing all their money. There are ways to pick stocks and to do well with them by picking really well-managed, long-standing companies that are innovating. And anyways, we won't get into that anymore today, but just something really important to know. Investing is not a get-rich-quick. You do hear a one-off story, right, of people who had the right pick. That's luck.
And there's people that do that for a living, like the day traders. And but they're not investing in one or two tickers, or they're not doing what Rachel does and invest in 3 and then just be like, oh, Jesus, take the wheel. They've got like their hand in many, many cookie jars. And I think overall, if they're good at it, will come out on top. But if they've won big, they've also lost big.
Absolutely. And it's almost more of a gambling approach at that point. And so that's where, for myself, I feel I like the Warren Buffett approach, where you are using ETFs over a long time horizon, compound interest. You have a wide variety of diversity. So you're diversifying your portfolio. So you've got some stocks, you've got some bonds, and you don't have it all in one company. You've got hundreds and hundreds and hundreds of companies potentially. So following like the S&P 500 is a common one out of the United States, which is the top 500 companies performing in the US or like that are, in the US. You can buy ETFs that follow the trend of that S&P 500, which historically that has produced 10 to 12% in returns over a long time horizon, 20 years type thing. So it's kind of like that average, like same idea. You were saying with the cookie jars, they kind of average it out, right? Yeah. And so, so interesting. So many good things.
Yeah.
Can I just say one more thing?
Of course you can. You can say many more things.
Oh, I just feel like I'm on a little like soapbox pedestal thing here now. But there was another thought that came to my head too, because I was watching this video and they were talking about buying luxury designers. And what I loved is like investors.
Pieces of companies or like buying an Yves Saint Laurent handbag?
Handbag. Yeah, exactly.
So buying
perfect
the actual
example.
The thing?
Yes, exactly. Okay. So buying this handbag, right?
Okay.
So here's the mindset of a consumer. I'm going to go support this company, look rich and wealthy by buying this handbag. But how the wealthy and investors think is they're like, I'm going to go buy stock or like ETFs in this company and I am going to get paid a dividend and actually a portion of their profits from these consumers who are just buying the bag. So I'm going to own part of the company, and with my dividends I'm going to go purchase that bag.
I like that.
I love that. I was like, that mindset is such one of wealth and just so you can have it both. I mean, if that's a priority to you, right?
I just I feel like saying like with a little zhuzh, like you wear Yves Saint Laurent. I am Yves Saint Laurent, Also, I own,
yes.
I don't have any YSL stock or goods. Just putting that out there. It's not like I'd have to read more stuff.
It's not my thing. Brand names, luxury brands, not at this point. I mean, I'd rather experiences like we've talked about. But
they're beautiful. But I'm not an owner.
But I would feel better about it if I was an owner of that and then also a wearer. So
at that point, if you're an owner, that bag is an investment, right, into yourself.
100%.
If you need to invest in it.
Yeah, exactly. Do you want to speak to Rach, just going to how you've switched your approach now?
Yes. So I will say, at the time that I was buying these individual stocks, I also am in mutual funds. So as I was dipping my toe in this like risky, oh, Rachel, you're so bad, let's buy a stock, I also had this very like conservative approach on the other side. So I don't have ETFs. I shouldn't say prefer, but what I've gotten comfortable with are mutual funds. So mutual funds consist of, similar to an ETF, where it's a portfolio. So you have many things bundled in one. So stocks, bonds, and other securities. And similar to the ETF, they just give you more variety and in that sense have different kind of risk tolerances within them. So the difference between mutual funds and ETFs you could trade throughout the day, just like you would an individual stock. But the mutual funds, you need to wait for a day's end where they take an average price during the day. And that's the value of your mutual fund. So, and if that was confusing to you, Google it, read it a couple times. But really simply put, I can only trade my mutual fund when the day closes and there's an average price, whereas ETFs, you can do it throughout the day. But I'm not trading my funds. Like I'm, like Steph said, Instapotting my approach. So I'm buying it and forgetting about it for the next 20 years. I mean, give or take. So that's been my approach. I did also, Steph, I shouldn't say my mom had a more conservative approach when I was younger, and she was into bonds. I remember having bonds in my name, and those were what she purchased and cashed out when I started university. So that's also something I was aware of. I couldn't even tell you what the coupon rate was, like what the interest rate was on those bonds, but I'm almost certain she had them for more than 10 years. And at that time, you were talking about, you mentioned earlier that you'd have to have like a little paper when you're, back in however many years ago to buy stock. This was a bond that came to our house and was on like very beautiful, thick, expensive paper. We were like, this is costly. And we had it in like a plastic that we put in the safe. Like it was a whole thing. I don't think that happens anymore, but it was kind of cool.
Pretty official. Yeah, I totally hear what you're saying. And like those bonds, like you said, Rach, I think too, historically, like there's been times where I think the rate of return has been really quite good. And that really fluctuates a lot. There's a lot within like the price of gold and these type of factors that influence the bonds a lot. So typically if like stocks are doing well, the bonds aren't doing as well. And if like stocks aren't doing as well, the bonds are doing better. So that's just a very broad generalization there. But yeah, the bonds, they are a safer bet. Like there's more security in it. There are more risky bonds though. That's the thing. You can have a more risky bond, so your rate of return is potentially greater as well. That just always goes hand in hand. Government bonds, though, that is something that is a little bit more lower risk, and often that's a lot of what most of us are getting some investments in. There is, variable interest rates. There's also, I just want to see here, because there's a really good example with the 5-year-old too, just to explain it really, really clear. But like Rach said, the interest rate for bonds is called the coupon rate. So rather than complicating it, they just suggest like it's just an interest rate. It means the exactly same thing.
And Steph, if I can comment on why, in case our listeners are curious, why government bonds tend to have lower rates. The idea is, so when you buy a bond, the terms of the agreement are that you will receive at the end of the term the coupon rate, the interest rate. So if Steph was issuing bonds, she says, okay, you can buy this bond for $100. You have to leave it. So you have to set it and forget it for 5 years. And at the end of those 5 years, you'll get 5% return plus your $100. So if Steph were governments tend not to ever fail. Governments will always, always pay their debts. Now, I know there's like a whole swath of governments globally, and some, for many global economic reasons, are not as reliable. But the government of Canada will always pay their dues. So that's why it's not risky, and so the interest rate, coupon rate, tends to be lower. Just a little comment there. In my line of work, we sell product to governments, and they basically are permitted any line of credit that they desire because their risk is negligible. So that's kind of my background there. But with our
thank
example.
you for sharing. Thank you for sharing. That's helpful. And I think it's just like there's a whole political component there that we are not going to go into, just around like the debt and everything. But yeah, so basically savings bonds, you're being invested in the government. And so when you are ready to trade in a bond for your initial investment, you get that plus interest. There are an expiry date, so there's a term for them typically, so kind of similar to a GIC, guaranteed income certificate or whatever that one's called. But yeah, very similar. So really two big reasons that we are investing in bonds in the portfolio would be because they're a good way to diversify portfolio and mitigate risk. And then also, lowering the risk of your investing options, and you get a guaranteed return. Yeah. And so bonds can be helpful so that your eggs are not in all one basket, and they really start to diversify and mitigate the risks like we already said.
Bonds were kind of a hot topic as interest rates started to increase, right? Just recently. Because the coupon rate, the interest rate should kind of trend with interest rate increases. I'd say one thing to be cognizant of is when you're looking at your interest rate, if you are considering a bond, is that interest rate is beating inflation. So just make sure you're aware of the inflation rate. In Canada right now, it's high. So bonds, if I'm going to put my money away, I just need to make sure that the interest rate I'm guaranteed at the end is going to be higher than inflation, so that my money, even with that interest rate, isn't losing value as it's sitting there collecting dust. So just
good point.
Cognizant of.
And I think that's why a lot of people are choosing to put their money into more of like a high yield savings account right now, just because for the difference in interest, and it's more liquid, accessible. A really important point. I just wanted to backtrack for a second too, though, right? Just with what you're saying with double checking based on like the inflation rate, and you want to just make sure that where you're putting your money is going to have, we can't guarantee your return outside of like bonds and GICs, but we can consider, like, for example, with a mutual fund or some of these other ones that you're using, you want to look at that MER, the management exchange ratio. And with mutual funds specifically, they're an actively managed, right? And so we want to make sure that that rate is going to be, so if it's like a 4% or 2.5%, and your rate of return based on historical data is only about 6%. Is there another way?
So that's a great point, and one that I, to be honest, don't recall if we've shared on this platform before. But my story with that MER is I was right with I will say them. They pissed me right off. I was with Investors Group, which was great at the beginning. I was like, great, I'm going to put my money away. I don't really know what to do with it. I'm 20. I'm just going to get this guy to do the things. I'll tell them my risk. They look at what I'm making and they say, okay, let's put this money away. Great. I had it in a fund. Fantastic. It was there for years. And that's fine. That's fine. It grew. It was okay. But when Steph and I started having these conversations, and I knew a little, not nearly what Steph had kind of been absorbing and hungry after for a few years, she was saying, Rachel, you need to look at your MER. What's the MER? And at this point, let's fast forward 10 years. I had a bunch of products with Investors Group. So I had my kids' RESPs, I had my RSPs, Aaron's RSPs, I had a Lira. There was a ton in there. So I was a good customer for this guy, because I think the more products they sell, and also I don't know if this is how Investors Group rewards their employees or compensates their employees, but if it's anything like a bank, the more products they sell, the more they make. So this guy was doing great, and I was okay with it. I signed on the dotted line. Like, I knew, right, that I was paying a price for him to manage these things for me. But then when I started looking at the details, and thank God for technology, because before you'd get a stack of papers in the mail and it's overwhelming. I didn't read everything. I didn't read the small print. But once it was online and you could just type
find and search. Yeah.
Like, it's so silly that that's what it took, but that's what it fucking took. So then I type it in, I see the MER, and I was like, oh my God,
Oh,
how
yeah.
could I have let this go for so long? It
Stomach
was
drop.
high.
Yeah.
I think it was over 4, some was 4%, some was 6%. Not just that, beware. So I email my guy at Investors Group and I say, hey, can you please confirm that these are the only fees that I am paying? That this percentage for this product, this percentage for this product. And I just thought, worst case, he replies and says, yes. No, there was a worser case. He replies and says, those are the MERs, but also there's a percentage we don't show. So when you added that on, it was just the next day the paperwork was in to move my money. Because not only was he taking, and this is where I felt like it got very emotional and very personal, he was taking a cut off of my money for my retirement, which, okay, sure. But then he was taking a cut off of the kids' education investment. And I just thought, no, like, that is not okay. Because that cut is not only just the money I invest, but it's the grant we're getting from the government. So I lost it. It was not a good ending of that relationship. He was not happy to see me go. He did not wish me luck. He basically said, let me know when you want to come back, as if I would fail. That was very long-winded and kind of emotional. But the point I'm getting at to support what Steph is saying is check your MERs. And if you are with someone who's actively managing the account, they work for you. You contact them and you say, can you please break it down for me, everything that you are getting from me as far as a fee, just in case there's something hidden there. Because I didn't think there would be, and there was.
Really, really beautiful share, Rach. So important. And I'm so happy. It's like better late than never.
Absolutely.
Right? To find this out. And so we can't change what's happened in the past. There's no point in sitting dwelling there. We just want to learn from it. And by sharing these stories, we are learning from each other. And it's so Thank you so much for sharing. You know, if you take nothing away from this episode today, what Rachel just said, check your MERs with whatever you have invested. So actively manage. So if you're through someone like Investors Group or like a bank, through most of your employee ones will be. They are like they're a mutual fund that are actively managed in there. Check them and email them. I strongly suggest emailing it, having in writing, because legally they have to respond to you and lay that all out if you're asking them that direct question. It's a lot harder, like legally they did do that in your reports or your papers you signed off in the agreement. But when you ask them directly, it's a lot more clear. And just, if you need to ask, are there any other fees that I should be aware of? Put it in an email.
Yeah. And to the point about the MERs for any funds that are managed or that are through your employer, it's likely your employer is not managing them, but they're using a financial institution. So I've mentioned before, my employer uses Sun Life. The employer tends to get a discount. So because I think of the magnitude of the investment when you put all your employees together. So still check, but those MERs tend not to be, it wasn't even close to what I was paying with Investors Group. And then the other thing to consider, and don't feel like this is too much homework. It doesn't have to be done in a day. It's just things to be aware of. But the other thing to consider if you're investing through your employer, even if that MER is slightly higher than what you might be getting as like your own personal, contributor to a Quest trade, your employer likely matches. So if your MER is a bit higher, but you're getting this free cash from your employer, there's also benefit there. So it doesn't mean, oh no, this MER is higher, I'm not going to invest here, I'm just going to invest everything in this other one. Just really think about whole picture, what you're getting when you invest through your employer, just to say that piece, because there's still a benefit there for me to do my employee piece of investing as well as my own on the side investing.
Right, exactly. Really clear points there and practical points to consider. Because often, if you can max out the amount that your employee is going to match, or your employer is going to match, then you would want to do that because that is, like Rach says, essentially free money to you. And then if you're investing above and beyond that, that's maybe when you consider a different account. And also, when you go and ask your MER, your management exchange ratio fee, for your accounts outside of your employer, what to do next. Don't worry about needing to take action right away. Once you have that information, then you can do more of your research around some of these other options for like robo-advisors, just lower fee options to, put more money in your pocket. Keep more money in your pocket.
When we first started talking about MERs, now like a couple of years ago, you shared with me like a target percentage. Do you want to just share with the people? So I just said my MER was ridiculous. It was like over 6%. What's a reasonable MER?
Less than 1%. Yeah. And you will never find that with an actively managed account. So I shouldn't say never.
This guy's
because
watch.
robo-advisor you could.
This guy's watch was ballin'. Like I should have known when I walked in.
I'm sure it was.
I paid for that watch. I paid for that fucking watch. I should have asked
that's hilarious. Isn't that annoying though? Yeah, it's like exactly. Oh, it's so annoying. And you understand they need to make a living, but when you see the splurges, I always love asking too when you're interviewing people, what's your investment strategy? What do you recommend? Because I love to hear what those guys, because if they're going to be managing your money, you better bet I want to make sure you're making money for yourself.
Yeah.
And not just off of your commissions from where you're putting other people's money.
Yeah. That's a good
fires
point.
Me up.
I also love that you said when you're interviewing these people, because they are working for you. Like if you think about if someone's going to work for you, you are interviewing them. Dairy Queen, McDonald's, Investors Group, doesn't matter what the fuck it is. Like treat it like what value are you going to bring to me? Because it's your whole, and I don't want to make it so heavy to say your future depends on it, but they will have a very big impact. So make sure that you are aligned.
Absolutely. And to make it clear, it's a huge impact over the long term. These are long-term relationships we're creating with these companies, these people. So with that being the case, it is hundreds of thousands of dollars at stake. Hundreds of thousands of dollars. In the short term, it's not that much. But when you look at it over long term, because of that compound interest that we talked about, it's hundreds of thousands of dollars. So just be aware there's a lot at stake. And for certain periods of time, it might be fine. But the funny thing is, Rach, my husband, Sean, he is hilarious. And he gives me such a hard time because with our accountant, I interviewed her and she said, Stephanie, I have never been interviewed by a client before. And I was like, really? People don't ask these questions? She's like, you were the first. And she's been doing this a long time. Like she's probably in her late 40s.
Good for you.
Well, I don't know if it's just my anyways, doesn't matter. It just empowered me. My attention to detail, and sometimes it's a blessing and a curse, and it's as I'm sure it's really annoying. But your job is not to, your job is to ask the questions. It's not to care about how people are perceiving you if you're being annoying, right?
Oh my gosh, what's the worst she's gonna say, or they are gonna say, is like, I don't want to do this, and you're like, you're not the right person for me.
Exactly.
Yeah.
Exactly.
There's no shame in that game.
No, absolutely. Okay. So there is so many amazing pieces here. Just to go back to put in perspective before we wrap up, the MER, so we want to go less than 1% ideally. For a lot of the ETFs, the all-in-one that I'm using that are like auto balancing, they are 0.24%. So that's a really big difference. It doesn't seem like it. Like on a $10,000 portfolio, it's about $4. But if you take into consideration over time, you're looking at thousands and thousands and thousands of dollars. Yeah.
For sure.
All right. Well, Rach, I just wanted to thank you so much for your shares and just so much learning, and that where you have shifted your perspective. And this is the beautiful thing too. We can shift. I have some shares too that we didn't even get to today, but trust me, I've made my fair share of mistakes as well, a lot on procrastination. So that's a whole different game and concern. And anyways,
yeah.
Rach.
No, thanks, Steph. And it's I know you said mistakes, and I don't take any offense to that at all. It's like learnings. That's kind of how I like to frame it in my head. Because
yes,
too, I'm so grateful to have been able to have learned those lessons this early on. Because to your point, even when you mentioned the MER, 0.2% on $10,000 is negligible. I shouldn't say negligible. It's small. But when we and our listeners who are going to be investing and growing their wealth get to the $2 million in 20 years, that makes a difference. And mistakes, learnings, when you have that much in the bank with those percentages, those are just so much harder to swallow. So I'm happy to have gone through it, before I was 35. And that's okay. And if it happens again when I'm 55, it fucking happens again. I'll just try and remember this moment and just have some gratitude for the journey, I suppose.
Well, and you know what? If you're not failing and make mistakes, and yes, it might sound like a harsh way to say it, but realistically, if you're playing small.
Yeah.
So right?
Yes. Yeah.
So we gotta, get over, it is human to make mistakes. It is human to fail. And if you're not failing, you need to try harder to fail.
Yeah. Fail forward.
Because you've got fail forward. As long as you're learning. I love that. You got a growth mindset. So anyways,
we could go on. We're just like, hey, we're going to wrap up. And then it's 10 minutes later. Hey, we're going to wrap up 10 minutes later. This is trying to get off the phone with my lovely mother-in-law. She's like, so I guess I better let you go, but did you know grandma, her blood pressure's high again? And,
oh my gosh.
Yeah, so I guess it's time for you to go, but I've got pasta on the stove. I'm just like, okay.
Yeah. Oh yeah, all the things. Well, it's so funny because Rach, I think next episode what it'd be awesome to do is have just a catch up over coffee and just chat with our listeners all about what's been going on, because I know there's been a lot going on for you and so many other areas just of life, right? And I'd love to share with the listeners just that different perspective of us.
Steph, I can't wait to just dive into how I, at my old age, am dealing with both acne and menopause. Can we just fucking chill out, universe, on the curveballs you're throwing?
Right?
Oh my god.
Midlife crises. Oh my. we're in it. And a lot of it's around health, the inflammation, all these things. I hear ya.
And
what is perimenopause? We're going to talk about it.
It's a slap in the face. This is what it is. I do want to, I know we're like, hey guys, next episode. Also, I have a 10-minute story to tell you. There's a movie on Prime that just came out with Anne Hathaway, The Idea of You. It's based on a novel. I watched it last night. I can't stop thinking about it. I want to watch it again today. It's just, to your point, I think I might be experiencing a bit of a midlife crisis right now. And Anne Hathaway plays a 40-year-old woman who falls in love with a man in his early 20s. And it's it's sexy, the chemistry is fantastic, and it just makes me think, fuck, I hope when I turn 40, I'm feeling that good about myself. I hope I look like Anne Hathaway. Or at least have her confidence. She's such a babe. And I But it was like all the things, all the feelings, like the age, the not being as hot as the 20-year-olds at the pool, the it just all came, it all overwhelmed me. I cried, I laughed, it was just everything. Aaron came downstairs. He's like, what is going on with you right now? I was like, I don't even talking about it, my eyes are getting watery. I'm not even sad. It's just, I feel so overwhelmed.
It's emotional.
With my age.
Relatable.
I can't wait to get into it.
Me too. I wrote that one down, Rach, so I'm going to have to watch it, and then we'll both be bubbling messes just talking about it. No. Okay, well, I'm just going to leave us all with this one little quote here. You learn basketball by playing basketball. You learn math by doing math. You learn business by starting a business. You learn investing by actually investing. Stop looking for the perfect moment. Just start, and I promise you'll figure it out along the way. This was also from That Market Hustle.
I like that. It's true. You gotta regatta.
Get going. Get after it, everyone. We will see you in the next episode, episode 6. Have a lovely couple of weeks. Take care.
Bye.
This podcast is designed to provide listeners and viewers with a general overview of how to start investing and growing wealth, provide value to our communities, and live a life of wellness. It is not designed to be a definitive investment guide or life guide to take the place of a qualified financial planner or other professionals. Given the risk involved in investing of almost any kind, there is no guarantee that the investment method suggested in your personal or financial life will be profitable. We do not assume liability of any kind for any losses that may be sustained as a result of applying the methods suggested in this podcast, and any such liability is hereby expressly disclaimed.